What if I told you that one of the world's most crucial industries is severely underinvested, overlooked, and primed to experience a violent repricing? An industry that moves 90% of the world's goods but has been so beaten down that few dare to touch it. Well, today we're talking about shipping. It's an industry many take for granted, but there's a major storm brewing, and smart, patient investors are positioning themselves to profit. We'll explore how a mix of supply shortages, rising freight rates, and shifting geopolitical landscapes is creating a perfect storm for the shipping sector, and why investors should pay attention. This video is produced by the team at Capitalist Exploits. Headed by professional asset managers Chris McIntosh and Brad McFadden, the team hunts for deep value assets that are surprisingly contrarian despite strong fundamental cases for potential future appreciation. If you're looking to gain access and insight as to the personal investments of active hedge fund managers and in-depth reasoning as to why they've invested in the assets they're sharing, check the links in the description below. You'll get access to advice on how to allocate, organize, and think about your portfolio while joining a growing community of people thinking outside of the box. Enjoy monthly updates, open Q&As, regular newsletters, a community forum, organized portfolios, investing education videos, and more with the Capitalist Exploits Insider subscription. If you're not ready to fully take the leap, we also offer the Capitalist Exploits Insider newsletter series for $1 for the first 30 days and $35 a month thereafter. Do note, our investing strategy and philosophy can deviate a lot from the mainstream. We offer a money-back guarantee regardless, but make sure you're on board with our investing philosophy and global outlook before deciding to join us. The shipping industry is one of the most cyclical sectors in the world, known for extreme boom and bust cycles. Freight rates soar during booms, driven by high demand and limited capacity, but they crash when oversupply floods the market. So, what does this mean for you as an investor? Well, in essence, timing is everything here. During bust periods, shipping companies often overbuild, resulting in excess capacity. But when the market bottoms out, it sets the stage for an inevitable recovery. Right now, we're emerging from one of these busts. New ship orders have dried up, and companies have scrapped old vessels, leading to a tightening in capacity. This has created undervalued assets, and smart investors are beginning to take notice. When sentiment shifts, shipping stocks often experience steep price appreciation. As the market shifts from negative to positive, particularly in segments like dry bulk and tankers, we're already seeing freight rates rise. Investors who can stomach the cyclicality and invest in pessimistic times stand to reap the rewards when the next upswing happens. One of the most significant factors affecting the shipping industry right now is the looming supply constraints. Many ships in the global fleet are nearing retirement age, especially in segments like dry bulk and tankers. Ships generally last about 20 to 25 years before they're scrapped, and a significant portion of the global fleet is approaching that threshold. At the same time, new ship orders are at historic lows. Ship owners are hesitant to invest in new builds due to environmental regulations, fuel technology uncertainty, and the scars of the last downturn. This lack of investment is setting the stage for a major supply crunch. Environmental regulations like the IMO 2020 sulfur cap are making it costly to operate older, less fuel-efficient vessels. Many owners are opting to scrap these ships rather than retrofit them, further tightening the supply of ships. The bottom line, the global shipping fleet isn't being replenished fast enough to meet future demand, which will drive up freight rates even more. Freight rates are the key profitability driver for shipping companies, and it's clear that rates are on the rise, particularly in dry bulk and container ship segments. The shipping industry operates with high operating leverage. This means that even small increases in freight rates can lead to massive profit margin expansion for shipping companies. Right now, we're seeing limited capacity combined with strong demand, which is pushing rates up. And as supply constraints worsen, these rates are expected to stay elevated, benefiting companies with modern, cost-efficient fleets. Although freight rates can be volatile, The long-term trend is clear. With supply shrinking and demand growing, rates will continue to rise. We believe that for investors with a long-term outlook who can weather short-term volatility, the potential for higher returns is immense. But the shipping industry isn't just about rates. It's about companies that have strengthened their financial position and are ready to capitalize on the next boom. Many shipping companies deleveraged during the recent downturn. They reduced their debt, restructured, and improved their balance sheets, putting themselves in a strong position for the next upcycle. Despite this, many of these companies are undervalued. Stocks are trading at significant discounts to their net asset values, creating a prime buying opportunity. All the companies we have in our Capitalist Exploits Insider portfolio, for instance, are trading below book value, even though they're generating strong earnings and paying out attractive dividends. These companies also often pay substantial dividends when freight rates rise. Some stocks in the sector are offering dividend yields of over 8%, making them appealing not just for growth investors, but also for income seekers. But as with any global industry, there are external forces shaping the future of shipping. One of the biggest is geopolitics. The shipping industry is deeply intertwined with global geopolitics. Events like the Russia-Ukraine conflict and tensions in East Asia are having significant impact on shipping routes, trade patterns, and costs. For example, the conflict has rerouted many shipping lanes, especially for energy products. Ships now have to travel longer distances, increasing demand for tanker capacity and driving up rates. Meanwhile, as the global economy decouples from China and shifts supply chains, the need for shipping services is growing. Rising demand for liquid natural gas and commodities like coal and iron are further boosting demand for shipping services. All of this supports a bullish outlook for the sector, particularly as supply constraints limit the number of available ships. To further add to the potent cocktail that is making shipping ever more intriguing for investors, the industry is undergoing significant consolidation. The top 10 shipping companies now control over 80% of the global market in some segments, such as container ships. This consolidation gives these companies greater pricing power and more control over rates and capacity. With fewer competitors, these major players can raise rates when demand increases. This consolidation trend is expected to continue, making the largest shipping companies even more profitable as they manage supply and demand imbalances. But it's not just market share that's changing. Technology is playing a critical role in shaping the future of shipping. The shipping industry is being pushed to adopt fuel-efficient ships and explore alternative energy sources like liquefied natural gas and hydrogen, largely due to strict environmental policies imposed by Western governments and regulatory bodies. Nevertheless, many companies in the sector are beginning to comply and invest in these technologies to adhere to regulations like the IMO 2020 sulfur cap and anticipated carbon restrictions. Companies that utilize these technologies will see benefits in operational efficiency, reducing fuel consumption and future-proofing their fleets against rising regulatory hurdles. That said, many of these green initiatives are adding unnecessary complexity and costs to the industry. But the reality is that companies that adopt these technologies early will have an operational advantage. Fuel-efficient ships and compliance with future regulations, regardless of their merit, will reduce fuel costs, a major operational expense, and allow these companies to remain competitive in a market constrained by regulatory pressures. While we fundamentally disagree with the ESG movement that's increasingly dominating Western markets, we can't ignore its impact on the shipping industry. The IMO 2020 sulfur cap was just the start. Stricter carbon emissions regulations are looming, and companies that fail to adapt face being pushed out of the market. Not because it's best for business, but because it's demanded by ESG-driven investors and governments prioritizing environmental optics over real economic needs. The push for lower emissions has compelled shipping companies to invest in expensive upgrades such as scrubbers or switch to low-sulfur fuels, all of which increase operational costs. Yet, companies that take these measures are in a better position to weather this storm of regulation. ESG-focused investors are driving capital to companies that signal compliance with these regulations, even though the long-term sustainability of these initiatives is questionable at best. In the short term, those who comply with the ESG narrative are likely to attract more capital, not because they're the best businesses, but because they're playing the game that modern markets are forcing upon them. We see this as a short-term advantage for these companies, even though the more distant long-term impact of stricter and stricter green policies may create inefficiencies in global shipping capacity and profitability. The shipping industry may be underinvested and overlooked, but it's also on the cusp of a major revaluation. With aging fleets, supply shortages, and rising freight rates, the sector is poised for significant growth. Investors with a long-term horizon and tolerance for cyclical volatility are well positioned to capitalize on the next shipping boom. The opportunity is clear. Those who are willing to ride out the storm could see outsized gains in the coming years. Shipping is one of the many themes or portfolios that we have organized in the Capitalist Exploits Insider Members section. To gain access to the specific companies we're looking at and even more in-depth rationale about the shipping industry and many other sectors, check out the links in the description below. The research used in this video is also available in the description below, and thank you so much for watching, and remember to stay informed.